Hello, and welcome to the Joss Brown Podcast. With over 40 years of combined financial planning experience serving high net worth clients, we will discuss our favorite topics, concepts, and stories.
Hello, and welcome back to the Joss Brown Podcast. I'm Philip Saunders.
I'm Dan Joss.
And today we're going to be talking about first quarter performance of 2025.
That's right.
So,
how'd we do?
We did all over the place. We were all over. So we'll start with fixed, go into U.S. stock, then international, and then finish out with some alternatives.
Great.
So for fixed income, the U.S. yield curve is still inverted.
Mm-hmm.
The 10-year treasuries are at 4.1%, 4.16, 5 years at 3.9, and then the 3-month issues are at 4.29. Munis are somewhat flat. The 5 years at 2.87, and then the 1 year is at 2.56%. And then in terms of performance, the U.S. Ag was up 2.78%, and then the FTSE non-U.S. World Government Bond Index was down 0.59%.
So the U.S. Ag performance of 2.78, that's like a stock market return.
Yes.
Right?
If like an average
for
average
three months,
market,
3 months up 2.5 to 3%.
Yeah,
that'd be
that's
like
over 3 months.
10 to 12% over the year if we annualize that.
Right. Yeah.
Now, obviously, the last year wasn't up 10%, but this quarter balanced out some of the loss in the stocks.
Yep. That's right.
Which is what we hoped it would do.
Absolutely. Yeah. And so you kind of alluded to it. So stocks didn't fare as well in the U.S. The S&P 500 was down 4.59%. And then the Russell 2000, which is small cap stocks, lagged that at minus 9.48%.
Yep.
And the international stocks, the EAFE, do you say EAFE?
Mm-hmm.
EAFE,
Mm-hmm.
which is Europe, Australasia, and the Far East index, was up 6.15, and that was driven a lot for the most part by European stocks that were up 9.86%.
Mm-hmm.
And then emerging markets lagged that, but still outperformed the U.S. at plus 2.41%.
Yep.
So,
and what also helped international stocks, I believe, is the dollar fell a little bit.
Yeah.
So that when that happens, international stocks do a little bit better.
Absolutely. Yeah, good point. And then,
so if bonds were positive, U.S. stocks were negative, international stocks were positive.
Then what do we think the alts were? They were
Never
also
know.
Positive. In terms of the U.S. REITs, which is real estate investment trusts, they were up 1%. Then global REITs were up 1.37%. So similarly, when you add international in to the REITs, that outperformed the U.S. REITs.
Okay.
Commodities, the S&P GSCI index was up 3.35%.
Yeah, and of that, gold I think was up 18%. Silver was up 17%.
Yeah, how about those returns?
Another good quarter.
Great quarter.
So on the whole, what we found was we were pretty close to zero.
Right.
With bonds and
As a
international
total
doing well
portfolio.
and REITs doing well, international stock dropped. We were flat.
Right.
Looked flat from the wrapper, but inside we saw things were all over the
There were
place.
some different things going on, sure.
Which
And
is
then when you look inside the U.S. wrapper, there was different things
That's
going
right.
on there too. Some
Yeah.
stocks were up, some were down.
yeah,
Yeah.
good.
Okay, and then to kind of talk a little bit deeper about that, if you will, at the start of the year, the average PE for U.S. stocks was at 30, and so a lot of economists thought that was a little high, and so that may explain some of that underperformance for the U.S. In terms,
It was historically, it was above average.
Absolutely.
Above historical
Well above
average. Yeah. So the newspapers and the websites will say a reversion to the mean a little bit.
Absolutely.
Stocks coming down, PE ratios coming down. Of course, that depends on earnings, which that'll change every day when they announce earnings, but for the most part, a movement towards the long-term historical average.
Absolutely. Yep, and then consumer confidence has declined as well. Spending was only up 0.1% in February. And so that's kind of another economic indicator where consumers are at and what they're buying, how much they're buying. I thought this was interesting. In a letter we're going to send out here soon to our clients, they called it the tariff tantrums. And then I think I've heard in the past Trump trade talks as well. So there's a lot of alliteration going on right now.
Mm-hmm.
But so this
always
is
trying to figure out what's going to happen in the future.
always trying to figure it out. Yeah, and so this is more recent in the last few days.
After the end
we've learned more after the end of the quarter. Exactly.
Yeah. Okay.
We've learned more about what those tariffs are going to look like, and so there's been some more uncertainty in the stock market, you could say. And so something that what's that?
I was watching one of the Stock Channel TV shows today, and this morning the guy was talking about the volatility in the market. He said, this morning stocks went down dramatically, and then they went up dramatically, and now they're back down dramatically. I mean, you could take that any day of the week that the stock market is going. I could just use that quote and just hit it on replay.
That's what it does. Yeah. Another quote I saw said, let's just say today is going to be an interesting day. And it's like, what does that mean? That doesn't tell me anything. Yeah, I can say that any day. Yeah, so it's funny to hear the headlines and what they say.
If you just heard what he said, it would be silly. But in context, what he was trying to convey was the VIX index, which measures the volatility, how much it goes up and down, was higher than normal.
Okay.
So, but he didn't say that.
Well, he should have just asked you.
No. Well, that's the problem with watching the news is sometimes maybe much of the time, they really don't say anything.
They don't get across what they're getting at.
Because they're all trying to guess the future, and since nobody knows the future, they just have to talk about the immediate past.
Vague terms as well. Yeah.
Yeah.
No, that's a good point. Yeah. Yeah, something we keep hearing is it's different this time. And so, something we kind of noted was so were presidential assassinations, and so were nuclear standoffs, so was 9/11 and COVID, and there's always...
So is the housing bubble,
there's always something new.
The dot-com bust. They were all unique in their own way, which meant by definition they're different.
Absolutely. Yeah, and so they always trigger big news headlines, and there's always big stories about it. There's always a lot of trade activity around those times. But what we said earlier, the price to earnings, what we've seen in history is that over time the stocks go back to what their intrinsic value is. And at the end of the day, we look at what is a stock. It's a business that has employees and either makes something or has an idea or a service.
Yep.
And makes a profit from that.
And the current price is the sum of what everyone thinks the future earnings are going to be worth.
Yes.
And then there's some noise of short-term traders in there. And so the near term, it moves a lot. And over the long run, you'll see very strong correlation to earnings.
Absolutely.
So people still buy food and clothing and
go out to the movies,
curtains.
Yeah, absolutely.
And eventually a car.
Maybe not go out to the movies in the bad times, but eventually they'll go back. Yeah. So let's sum it all up. Dimensional Fund Advisors likes to say, stay in your seat for the entire show. They say stay in your seat, but I added the entire show to show that the show's not over yet. Your financial plan isn't up yet. Don't panic yet. Stay in your seat, ride for the ups and downs.
Yeah.
And that'll...
None of our clients, and I would submit that nobody watching this video needs all of their money this week, or even most of their money in the next 3 or 4 or 5 years.
Right. Yeah. Absolutely.
If you do, it should be in cash, earning
a good return,
a reasonable rate.
Yeah,
which could be 4% or so.
Absolutely.
that little piece of this video will age poorly.
It will. Yeah. Well,
I-
Catherine likes to say that back in the day, Cash used to earn a lot more.
I used to have a book
10%.
that I took off my grandfather's shelf. It was a finance book, and the interest rates in the back of the book only went down to 10%.
I mean, how? I'm the opposite.
And that was in the
I never thought Cash earned anything.
Yeah, that was in the mid to late 80s, and the decade before that, interest rates for mortgages were 15%. So
Wow.
10% was
Wow.
unreasonably
That's a cheap rate.
low.
Yeah.
Yeah.
Cheap rate.
So
Well, back then you probably paid cash for your houses. You didn't need a mortgage.
no, you needed to borrow for that.
And so, another point: ignore the predictions, recall your goals, stay the course, rebalance, and stick to your strategy. So don't start changing your portfolio too much. Rebalance and stay the course.
Well, have a strategy, a
strategy.
discipline. You say stay in your seat for the entire show, like there's a lull to the music. I've heard it more interestingly similar to a hockey game. I mean, how many hockey goals on average are there in a game? 3, 4, 5.
Probably. Yeah.
Like, you miss one of those, you miss 20% of the game. If you missed 2 of those because you were getting popcorn or something, you missed 40% of the game.
Yeah.
And
so in the
it just
stock market,
changes immediately.
The losses may come.
Both the losses and the gains come very quickly.
That's what I'm. Yeah, exactly.
Very quickly.
But yeah, also the gains may come quickly,
Yep.
and so don't miss those when they come.
Yep.
Yeah, stay in your seat. And then lastly, just create or hone your financial plan. That your friends may not have the same goals, the same financial plan as you, and so don't necessarily pay attention to what they're saying about the markets.
That's right.
Yeah.
Good advice.
Thank you. Okay, well, I think that's all for today.
That's great.
All right, well, thanks for listening, and we'll see you next time on the Josh Brown Podcast.
Thank you for tuning in to today's episode of the Josh Brown Podcast. If you'd like to see more episodes, visit our website at joshbrown.com.